Hi, welcome back to the Audit F8 classes, and we will continue from where we left last session. In the last session, we spoke about the audit process. All right, and as I mentioned, now it's our time to do the audit question, right? An exam kind of question. So before you head to the question, I would like to give you a structure of how audit risk question should be answered, right? So I would like to give you some strategies there. Now, what are the strategies? Number one, you need to be able to identify what are the common audit risk in a scenario. Yeah, so I'll be telling you what are the common audit risks in a particular scenario, and then you need to be able to know what is the exam format, the exam answer format in the exam. Yeah, so when you see an audit risk question, how should you answer it? Yeah, so I'll be giving you an answer format, a form of a structure, as well as all the common audit risks. All right, so common audit risks. Common audit risks I have seen on all the past exams are these common audit risks. Yeah, common audit risks. I like to summarize it and then put it in an acronym, and I call it finding asset. Finding asset. Okay, you must be wondering what is this finding asset. It's not a concept, it's just an acronym. F is the risk of fraud. Yeah, risk of fraud. Why are we worried about fraud? We are not responsible to detect fraud, but we are responsible to respond to the risk of fraud, because fraud could have an impact on the financial statement. All right, because your financial statement may be misstated because of fraud. So remember, we are not responsible for fraud, but the impact of fraud affects financial statement. That is what we are responsible for. Yeah, so risk of fraud could result in misstatement. Okay, whenever you see a potential fraud story in the exam, you must always ask, has there been any similar fraud in another department? So if the exam says that there was a recent fraudulent case done by the purchase manager, so the auditor will wonder, was that the only fraud, or was there any other fraud in the same department? So we need to extend our search. Yeah, so there is an extend the search to other similar fraud. Yeah, hence causing a bigger misstatement, any and similar fraud. Okay, so number one is risk of fraud. Number two, you will have a scenario where you have incentive to manipulate. Incentive to manipulate. Okay, now why will you have incentive to manipulate? Because the management has been offered, for example, you have a bonus on sales. A very common scenario. Companies give bonus on the sales performance. So what is the risk? The risk is there is an incentive. So we didn't say that there is a manipulation. We are saying that there is an incentive to manipulate. So the bonus creates a risk to the financial statement because the sales could be overstated. Right? The sales could be overstated. So we need that. It creates a direct risk on a particular account and a particular assertion. So there is an incentive to manipulate. Sometimes you will have bonus on sales, bonus on profits. Sometimes you may even have banks who make a condition in the loan agreement that you must maintain a certain uh, interest cover. So if your interest cover is not 5, for example, then we will withdraw the loan. So what the company has, I mean, incentive to do is to they will try to manipulate the profits by transferring some of the expenses to the next year. Yeah, so then you will have to see if there are any cut off errors. Okay, so you will have an incentive to manipulate, possible incentive to manipulate. Then number 3, N, I'm referring to non-compliance with law and regulation. Okay, why are we thinking about law and regulation? Because there are laws and regulation which has a direct effect. Yeah, for example, I may have been under customer lawsuit under, and because I did not satisfy the customer and there has been some misrepresentation to the customer. So as a result, I have been sued and the customer has high chances of winning that particular case. So meaning we will have an impact on the provisions that we have to create. So non-compliance with law and regulation could result in provisions. Yeah, under IAS 37. It may also have an indirect effect. Example is we did not follow the right tax rates. You know, we followed a wrong tax rate either deliberately or by error. But that particular using the wrong tax rates, actually it is something to do with the company's compliance with the law. We are not responsible for the company that they follow the law and regulation, or it's not the auditor's responsibility. But remember, similar to fraud, we are responsible for the consequences of non-compliance. Because of non-compliance, tax rates are wrong. As a result, the income tax expense in the SOPL, it is misstated. Can you get that? So because of that, it will have, example is, it will have an impact on the financial statements. So example is the wrong tax rates. Okay, then so you have FIN, fraud. We have a risk of fraud. You have incentive to manipulate. You have non-compliance, and then D, number 4. Okay, this one is your when you have disclosures are inappropriate or incomplete. Okay, so if you have inappropriate and incomplete disclosures, meaning you are having a problem, which is that you are not complying with the IS. So we need to look at disclosures very closely, because the investors are understanding the financial statements clearly through the disclosure notes. Yeah, so disclosure notes can be used as one of the items under the audit risk. So I have, my account is good, but my disclosures are not complete. Okay, common scenario is when there is a natural disaster, then the insurance policy coverage of that particular disaster, how much is the insurance company covering, must be mentioned in the disclosure. Another example is IS 16 revaluation. You must also mention what was the basis of the revaluation. Okay, so that will be your disclosure. And then you have I again, right? Number Fine. You have inappropriate management estimates. Yeah. So you see, when it comes to uh, calculations which are based on transactions like sales, purchase, those are easily verifiable figures. You have a supporting document, right? Sales has a supporting document of goods dispatch note. Purchase has a supporting document of the goods received notes, right? There is a supporting document. But when it comes to estimates, it is based on judgment. All right. What are the examples of estimate? Example is useful life. Can you see? Now, useful life is based on estimates, right? So as a result, estimates are bit difficult to verify because it's based on management. So what you need to see is you need to assess whether these estimates are reasonable or not. So this becomes one of the risks when, for example, in the exam scenario, you see that there is a change in the useful life. The useful life has been increased. The estimate in the useful life has been increased. So you can make a risk that, oh, if they have increased the useful life, meaning they are trying to make the depreciation expense go lower per year. Why? Maybe they want to increase the level of profits. So there is a possible manipulation of the profits because of inappropriate management estimates. Okay, so that is a potential issue. Okay, then you have another end. You have non-compliance, risk of non-compliance with IS, yeah, or IFRS. What are the common ISs and IFRS that regularly is brought up in the F8 exam scenario? I could summarize it for you. You will always have IS2 inventory issue, right? Inventory issue very typically is about the valuation, particularly if you see damaged, obsolete, or slow moving stock, right? Why? Because we know that it has to be at the lower of cost and NRV. So we have to use uh, post year end data to see whether the stock that is there in the warehouse is it able to be sold at above the cost. Because if there is any risk that the goods are not going to be able to be sold above the cost because it is damaged, or because it is out of trend, or because it has been there for very long, it is very dusty, goods are not moving, then you have to record the stock at net realizable value. Or there is even a possibility you may have to write off the inventory at value of zero. You see, so IS2 is regularly in a scenario. Another common IS that regularly comes is IS38. IS38 is normally about your research and development. Okay. Now, what is the problem? We have a risk that research expenses are capitalized instead of expense, because IS38 says that all research which has got to do with know-how must be expensed. We cannot capitalize those research expenses because there is no clear future benefits from that knowledge, right? But development can be capitalized if you satisfy certain criteria. Can you understand? So now there is a risk then that the research expense has been capitalized, and what is the risk is the development cost has been capitalized but it didn't meet the criteria. Yeah, for example, they are developing a product, and then exam scenario will say that we have a new product. We are launching a new product, and then the development cost is capitalized. So you need to ask, can you prove to me whether the product that you are developing has met the criteria of capitalizing development costs. One of it is, for example, uh, are you sure that there is a market research to support that we are actually going to be able to sell this? Customers will want to buy this product. Do you have any market research? Because if you don't have that market research, meaning there is a chance that customers do not want to buy this, hence there is no marketability, and hence the benefits of this development may not be easily feasible. Because of that, development cost will become an expense and not an asset. Can you see that? So IS 38 is also commonly tested, and you also have IS 37, which is creating provisions. So you must be sensitive to scenarios which require creating provisions. Yeah, uh, I assume that you are learning IS 37 in your F7 sessions, right? And then you have your IS 36, which is got to do with your impairment. Yeah, whenever you see exams case words which says words like surplus assets, assets are not used, so there is a high risk that maybe these assets need to be impaired. Yeah, there's an impairment of this assets, so we need to write down the value of the assets. Okay, so IS2, IS 38, 37, 36, um, of course IS 16, you cannot skip that, which is got to do with your PPE. Most of the PPE issues are about classification. Yeah, about classification. Why? Because certain items need to be expensed. Okay, why? Because they are revenue expenditure. Revenue expenditure. The other one, you may need to capitalize it as part of the asset because it's a capital expenditure. So this classification risk of items is there when you have a scenario. For example, the company has spent a huge amount, and then they like to capitalize it as part of the PPE. But you need to ask this question: can you give me a breakdown of your expenses? Because there is a risk that items which were meant to be part of the asset are expense, and there's a risk that items which are supposed to be expensed of are part of the asset. So there is a lot of risk about classification when it comes to non-compliance with IAS and IFRS. So 2, 38, 37, 36, 16 are regular ISs under question. Okay. Then moving on. So this is our N finding. Then we have G. Where is G? This is number 6. So we have number 7. Yeah, G. G is the risk of going concern assumption being not appropriate. Being not appropriate. Okay, if your going concern assumption is not appropriate because you see in the exam scenario that a huge major customer is withdrawing, yeah, from our business. Yeah, major customer is gone from our business. Let's say we are having, so this is normally about major customers leaving, and then you have a key supplier. Key supplier wants to stop supplying to us. Yeah, because maybe we have not been paying to him on time, resulting in our reputation being down, and as a result, suppliers don't want to provide us credit limit anymore, and we are losing them. Yeah, so key supplier is withdrawing. 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 Yeah. Another major issue is about having cash deficits, right? Or a very high gearing, or a high leverage. Yeah. So if you have business which is highly dependent on debts, more than equity, above 50% of the capital employed is debts, then the risk is high because you may not be able to pay the interest expense. As a result, the lender can force you to go to court and force you to be declared bankrupt. As a result, the company may not be able to continue because you are not able to pay your liabilities. So going concern assumption not appropriate. How does it affect our financial statements? It affects the financial statement because we need to remember in my previous session I have said that going concern makes the financial statement not able to be recorded on historical cost anymore, because now you have to record everything on breakup basis or realizable values. Can you see? So going as an assumption being not appropriate is also a risk. All right. So that is one scenario. Then you have eight. So finding. Yeah. So I hope you are following me. Finding, and then the eight is A asset. A. What is the A? A. I'm talking about analytical review. Analytical review. Now, and what is analytical review? You are comparing expectation or trend with your actual. Okay, these expectations come from within the financial statement, meaning example, gross profit margin, example, uh, selling and distribution as a percentage of sales. I give you an example. We have this expectation that we already know that the company's gross profit margin policy is that they do not do any trading below 30%, for example, is already a company's policy. So, but when we come to see that the actual gross profit margin is only 20%, what does it tell you? It tells you that either the sales, either the sales is understated, or your sales is understated, or your cost of sale has been my sales is understated, or my cost of sale is overstated. So it immediately gives you an indication of a potential risk. Why my sales is understated? Possibly because of cutoff error, possibly because deliberately incentive to manipulate sales because maybe they want to skip taxes. Yeah, that they want to reduce tax. We don't know. But anyway, these are all risks. So we can think about all the possibility. It doesn't have to talk about actual event. It's just talking about risk, meaning what can go wrong. Okay. So you have gross profit margin policy compared with the actual, or selling and distribution as a percentage sales. For example, we already have last year's trend that that selling and distribution. Because what is selling and distribution? Is salesman's commission, transportation. So the more the sales, the higher is the selling and distribution. So it will be unreasonable that sales have gone up, but selling and distribution as a percentage of sales is going down, for example. So the scenario is that sales percentage, yeah, sales is going up, but your selling and distribution is going down as a percentage, yeah, as a percentage of sales. Yeah. That means what has happened, the selling and distribution may have been understated. By how? Maybe they have either misclassified this. Some of the selling and distribution expenses may have been gone to cost of sales, or may have gone to administration expense. There is a wrong classification. Okay. Or there is a genuine overstatement of the sales. Can you see? So by doing this ratio analysis, trend analysis, you can able to get indication that what are the potential accounts which is at the risk of misstatements. How? By using analytical review. Right? Then that's your A. Yeah. Then you have C. Sorry, finding asset. Yes, C. Right, C is your potential cutoff errors. Okay, and then I, you may have inappropriate transition from old system to new system. A very common exam scenario is that the company has just gone through uh, new software. Yeah, when you have a new software that is being installed in the company, there are two risks. Number one is that you may have duplication of data. Yeah, duplication of data. The the other one is you may have loss of data. Some of your data may be lost because when you are doing your from one old system to the new system, maybe part of the data was lost in transition. Yeah, so whenever you have this old system moving to new system, there is always a risk of the controls are weak to detect the duplication of data or the loss of data, right? Resulting in misstatement, right? And then D is your detection risk. Why you have a detection risk? Because the exam scenario told you that the management is forcing the auditor to finish the audit faster. You know, they pressurize you. So a lot of time pressure is put into the audit team. Another exam scenario is that you may have a lot of scenarios. In fact, says that you have multiple warehouse location, for example. Yeah. Now, because you have multiple warehouse locations, then you have a risk that you may not be able to send the audit team to all the warehouse, and as a result, you will not be able to detect any exceptions, meaning from the records to the actual inventory, all those figures which are not matching and why they are not matching, that data will not be with you because you may not be given those exceptions, right? So whenever you have multiple warehouse locations, it also gives you, because your audit procedure becomes ineffective when you have this scenario. Yeah, so time pressure, multiple warehouse locations, or you just do not have you don't have the right people to do the audit. Yeah, we are very specialized industry, very specialized industry, and as a result, you may not have the people to do this. Yeah, so I like to put this in the finding asset format, because I tell my students, when you get the exam question, put finding asset on the next to the question, because you already know, okay, what are the possible scenarios that are going to be coming in. All right. So if I go through with you again, what is finding asset? Yeah. All right. F, risk of fraud. Yeah, incentive to manipulate. Then N, non-compliance with law and regulation. D, disclosures are inappropriate. Then your another I, what is your another I? You have inappropriate management estimates, right? Which is got to do with your judgments. Then you have N, right? Your non-compliance with IS or your IFRS. G is your going concern problems, right? A, the ratios, the expected figures and the actual figures are largely significant fluctuations, or there are significant differences between your expected figure and your actual figure, also a potential risk of misstatement. Okay, then you have your C, that you have a cutoff error, possibly cutoff error, and then your I, you have a transition from old system to the new system, so you have inappropriate transition. Okay, and D is your basically your detection risk. Why you have detection risk? Because your time pressure. Yeah. So write this down. Write the finding asset and regularly talk about other possible scenarios. When you see an exam scenario, you already put this on the side of the question. Okay. So you know what are the possible scenarios. Now, once you already know the possible scenarios, as I said to you, now I want to talk to you about exam answer format or structure. Okay, so what the examiner is expecting from you is this. They are expecting about the exam structure, not exam structure, answer structure. Yeah, answer format. Answer format. Audit risk questions are always in this format. They are expecting you to write audit risk on one side of the table, and then they are expecting you to put audit response on other side of the table. Yeah, so they want you to present it in tabular format. That is one point. Okay, number two, when you are writing your answers, because the markers are marking thousands of papers, my advice to you is that put headings. Yeah, whenever you start, for example, you put one heading and you say there's a risk of overvaluation of inventory. So the examiner already can see that you already have one heading, right? So my second advice is use headings, right? Then how do you start an answer? That is the question students often ask me. My answer is that it's good to have a structure in your mind. What is the structure? I like to say that start the question about saying this. There is a risk of, say what risk you have seen based on your finding asset. Yeah, based on your finding asset. Don't say there is a misstatement. Just say there is a risk of, because please remember, our risk assessment is done at the planning stage. You haven't started collecting evidence. You even are not having evidence that whatever risk you have thought about, is it actually confirmed. Yeah, that's what we will do in the audit response, confirming the suspectability of a particular risk. So we cannot say there is, we have to say there is a risk of. Okay, then I say what is the risk, and then I say because of what. Why do you think there is this risk? You must say because there is a possible, for example, if you're talking about inventory, because there is a possibility that inventory may need to be sold below the cost as it has been damaged or as it is obsolete, right? So there is a risk of something because of what? Yeah, so you must give this because of what. Okay, then after that, then you must use the word this means, or you use the word hence. Hence, this could result in. You must now say, is it a overstatement or understatement of which account, right? Is it which account is being overstated, or which transaction it is overstating or understating? So you must talk about the words overstating and understating. Which account or which transaction is overstated or understated, and then you must mention the last sentence. So my first second sentence about this could result in overstatement, understatement of which account and transaction, and the end resulting in over or understatement of the impact on the profit and loss. Yeah. So it's always about impact in profit and loss, and the impact of over and understatement of assets and liabilities in SOFP. So you see, your analysis is structured. What you are saying, you are first saying what is the risk of. Your risk is not based from the air. You are not just imagining and being a paranoid. You are actually having a reason why you are thinking about a particular risk based on the scenario. But then you must say what this means. This means there is a possible overstatement or understatement of a particular account. For example, the inventory could be overstated. Yeah. For example, an expense could be overstated or understated, resulting in what? Resulting in over or understatement of profit or loss in the SOPL, or resulting in inventory in SOFP. So I'm covering both SOPL and SOFP. Then one more very important item which examiner is mentioned. You must mention the impact on the assertion. This could impact the assertion of which assertion? Are you talking about completeness? Are you talking about occurrence? Which assertion is impacted? So can I break down your answer to 4 things? Yeah. Number 1, what is the risk of? Then number which and because of what? Yeah. Number 2 is what is the impact on your SOPL and SOFP, right? Actually, maybe this one, the because of is the number 2. Number 3 is the impact on the SOPL and SOFP. Number 4 is this paragraph. What is the impact on the assertion? Can you digest this kind of structure? Because you cannot just copy sentences from the scenario and put in your answer and expect to get marks. It will not happen. Yeah, so you need to show your analytical skills, that I know what is the risk. I'm saying why I'm thinking about this risk. What is the possible impact on the account itself, on the SOPL and the SOFP, and which assertion I'm worried about. Because all this gives me a direction. Okay, I must focus on the completeness. I should focus on the occurrence on this account. You see, you remember what is audit strategy? Audit strategy is giving directions to which account where we should focus on, resulting in I make the audit plan on that particular account. Yeah, so that's the whole idea of risk assessment, is to give directions. So your answer should give directions. Okay, that is a audit risk kind of answer. Then we have audit response. Now, what is audit response? Audit response, please remember, audit response is not your audit plan, because you don't have to give a whole detailed audit plan. Take the opening balance, obtain the breakdown, all these things. I mean, you need to do that, but you're not going to go into the details. My point is, no need to go into the details, because this is only. So please remember, what is audit response? Audit response is to verify the suspectability of a risk, right? I am having a suspicion. I am thinking that there is a risk inventory is overvalued. My job now is to respond. How can I test whether the inventory is really overvalued? How can I test? So I just have to write simple answers like this. I have to say, what will I do to confirm my suspicion? So I will say that I will perform post year end analysis to assess the selling price of inventory after the year end and determine whether the selling price is below cost, resulting in a need to write down the inventory as per IS2. You see what you're doing? You are going to after the year end, post year end, right? Post year end, and you are trying to see whether after the year end, what was the selling price of the inventory? Because at the inventory they recorded everything at cost, but you have a suspicion that I don't think the inventory should be recorded at cost. I think the selling price of this inventory is below the cost. So I need to write it down. That's your suspicion. So what you need to do? You need to say, okay, what is my technique is I'm going to do subsequent event review or post year end review to see how much was the actual selling price after the year end. And I determine whether the selling price is below cost. And if it is, I need to write down the inventory as per IS2. Yeah, resulting in a need to write down the inventory. Okay. Then your second response could be discuss with the management, okay, on the need to write down the inventory. Or if the management says, in some exam scenario says that the management does not want to write down the inventory, right, because they feel that they are able to sell. So you need to say, discuss with the management on the rationale for not writing down the inventory and assess its reasonableness. So your second answer normally revolves around discussing. So you are detested, but remember, you are not the accountant. You cannot write down the inventory. The writing down, all the adjustments are done by the client. So it's very important that you discuss with the manager. Maybe on the adjustment. Okay. Discuss with the management. So I'll show you more examples on the audit response. But please remember, my general guideline is for the audit response, it must be something that is imaginable. Yeah, you don't write something which the auditor, the audit manager, or the audit supervisor is not able to imagine what you want him to do. Yeah, so because at this planning level, basically you have to imagine that you are the one who is creating the strategy. You are the audit partner, or you are the senior manager who's coming up. Okay, I think our strategy should be on inventory. So what I want my manager to do is think about post year end analysis on inventory. So you are giving a direction. Remember, you are giving direction. You are giving audit strategy. So give directions which are imaginable, meaning you need to use your logic. So after you write an answer, make it a habit to read again what you're writing. If you are a junior auditor, are you able to do what you have written yourself. If you yourself are confused by what you have written, please rewrite your answer or readjust your answers. Yeah. So always remember, it has to be imaginable to a junior auditor. It must be executable. It must be imaginable. Don't write things which are just too theoretical and not executable. Yeah, it's very important in audit paper. You must write which is logical. So this is the format that I would like to give you. So remember how to answer audit risk kind of question, and how to make verification on your suspicion on a particular risk that you have seen, right? General response, because it's an audit strategy, it is not audit plan. If you are actually auditing the inventory, then you have to have a separate procedures, meaning I have to confirm about the cost, I have to obtain the breakdown, I have to confirm opening balance, I have to see the movements. That is all detailed testing. But here I'm talking about a particular risk that is there, which is about valuation. Then I must talk about this. Yeah, so I hope you're clear about audit risk and audit response strategy. Yeah, so the first part I have told you all the common audit risk. Number two, I've told you what should be the exam answer structure. Okay, all right. So in the next session, we will record the actual doing of a question. All right. Thank you.